The market responded by selling the stock on a volume nearly 3 times the 30-day average. The share price fell 6.4% on the same day management announced a record dividend. That is not a contradiction. That is the market reading the footnotes faster than the headline. I had to run the data twice because I did not believe it the first time. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. This audit is for the Central Provident Fund or Supplemental Retirement Scheme income investor asking one single question: is the income from this stock structurally sound? We do not care whether the chief executive officer sounded confident on the earnings call or whether analysts have a buy rating. We only care whether the cash backing your distribution is genuinely earned from running the core business. The answer is always in the footnotes. Let us go to what management said. The headlines looked exceptional. Net profit hit 5.61 billion Singapore dollars, up 40% year on year. Full year revenue reached $14.26 billion, and annual distribution per share hit 18.5 cents, the highest in company history. Yet the share price closed at $4.70 on results day, down 6.37% on 3 times average volume. When a stock drops on heavy volume the same day a record dividend is declared, the market is telling you something specific. To read that 40% profit headline correctly, we have to separate repeatable profit from one-time profit. Core operations like mobile plans and data services create a steady, recurring stream of income. Non-recurring events, selling a stake, booking currency gains, provide a single influx of cash. Singtel's 40% jump is heavily weighted toward Bharti Airtel stake transactions and foreign exchange gains. Real money but not recurring. Strip out these one-time items and underlying net profit growth drops to 20%. For the second half specifically, underlying growth was 10.6% on revenue growth of 2.7%. That 10.6% organic operational growth is the number that actually matters. For the long-term income investor, this is the only profit figure you can count on to repeat. Retirement income must be funded by the regular business, not by asset disposals, not by selling the furniture. Now for the regional complexity. Singtel is not just a Singapore telecommunications company. It holds significant stakes in Bharti Airtel India and Advanced Info Service Thailand. In financial year 2026, Airtel Africa and South Asia operations pushed $297 million of below-the-line losses straight into Singtel's results. That means you are holding indirect exposure to a pan-African telecommunications network, adding a layer of earnings volatility that a local income investor might not have priced in. There are 2 genuine bright spots in core operations. First, NCS achieved record bookings as artificial intelligence project demand surges across the region. These bookings signal strong organic earnings ahead as projects deliver. Second, Digital Infraco and the NXura data center business hit new operational milestones, highlighted by the consortium's $13.8 billion acquisition of ST Telemedia Global Data Centers, the largest transaction in the program. These 2 engines represent organic revenue streams that can fund future dividends without relying on asset sales. Now for the number management spent the least time on, the value realization dividend. Out of your 18.5 cents total distribution, 5.1 cents is paid directly from asset sale proceeds. That is 27.6% of your annual income coming from non-operational sources. Worse, this component grew from 4.7 cents last year to 5.1 cents this year. The direction of travel is the wrong way. Singtel needs roughly $3.3 billion in asset transactions over the next 4 years to sustain this payout. Delays mean your income drops. When we look at what the numbers say this stock is worth, the Investing Pro fair value model calculates $4.26 per share. With the post-results price sitting at $4.59, the stock is trading 7.7% above forensic fair value. It is like paying 7.7% above the wet market price for a fish. You need it to get fresher, not less fresh, to justify the entry premium. The analyst community remains split. DBS Vickers rates it a hold with a target of $5.36, noting the core Singapore business trades at 7 times forward earnings before interest, taxes, depreciation and amortization. Limited re-rating room. They also flag StarHub margin pressure and see a 5 to 6% downside risk to next year's consensus estimates. UOB Kay Hian, OCBC and Maybank maintain buy ratings with a consensus target of $5.33. On the institutional side, Capital Group has been accumulating purchasing 19.3 million shares at an average of $4.67 to raise its stake to 5.10%. To stress test this yield, I apply a conservative personal floor of 3.2%. Even though the Singapore Treasury bill rate sits at 1.4% in May 2026, I do not lower my standards to match a temporary rate. Adding a mandatory 150 basis points risk premium gives a minimum yield hurdle of 4.7%. This risk premium is the minimum compensation required before taking equity risk with retirement capital. We audit for the storm, not just the sunny day. Here is the yield verdict. At $4.59 with an 18.5-cent distribution, the current yield is 4.03%. This passes our absolute forensic floor of 3.2%, but it fails our minimum hurdle of 4.7% by 67 basis points. Consider this. The CPF special account pays 4.0% with zero balance sheet risk and full government backing. Singtel's yield premium over a guaranteed government rate is just 3 basis points. We also have to watch the October 2026 bond maturity. Singtel has $500 million United States dollars of debt due on October 3rd, 2026. The existing coupon of 2.375% is very cheap by today's standards, meaning refinancing within the next 6 months will happen at higher market rates. An interest coverage ratio of 19 times means this is not a solvency question, but it does put modest upward pressure on future interest costs, and that flows through to the free cash flow available for dividends. Here is what the income table actually shows. Total distribution per share fails the yield hurdle at 4.03%. Core distribution clears the floor, but full-year revenue growth is marginal at 0.81%. Underlying net profit growth of 21% is a pass. Free cash flow yield is tight at 3.23%. Most importantly, the core yield of 2.92% only clears the forensic floor because the 5.1-cent value realization dividend is included. Remove asset recycling funded income and core operations fail to meet our sanctuary minimum. Now the debt picture. The balance sheet is a genuine strength. Net debt to EBITDA is exceptional at 1.30 times and improving. The interest coverage ratio is a fortress like 19 times. Total debt is stable at $11.679 billion and cash and short-term investments rose to $3.47 billion. The flag debt maturity carries refinancing risk, but cash from investing shows a positive $4.3 million inflow, proving that the asset recycling mechanism is actively working. The risk lives in the distribution architecture, not the debt. This slide explains why the balance sheet looks so clean despite heavy capital spending. Singtel deployed $2.48 billion in capital expenditure, data centers, networks, NCS infrastructure. That is real investment in the business. But $2.08 billion flowed back in from disposals and returns, and a further $347 million from divestiture proceeds. The result, net investing cash flow turns positive. The asset recycling program is not just a management talking point. The numbers confirm it is actively working. On management credibility, their operational commitments have been delivered. Underlying profit grew 21%. Core distribution rose 8.94% to 13.4 cents. And $3.9 billion in asset recycling was executed. But the unanswered question is structural. This is the question management did not answer on the earnings call. The value realization dividend grew from 4.7 cents to 5.1 cents. The dependency on asset sales is getting larger, not smaller, until the core dividend can stand on its own without recycling proceeds. The record headline and the forensic reality are telling two different stories. While free subscribers are reading yesterday's story, Iggy's elite investors are already cross-checking the next setup together in real time. You get zero-day breakdowns and institutional-grade cheat sheets before the market opens, not after it has already moved. For $9 a month, stop being the exit liquidity and start being the analyst. Here is our scenario analysis. The base case carries a 60% probability asset recycling stays on schedule. The 18.5-cent payout is maintained, though the yield remains below our hurdle. The bear case is a 20% probability an Optus sale delay or deeper African losses contract the distribution to the 15 to 16 cent range, causing a $100 to $175 income loss on a $50,000 holding. The bull case is also 20%. The price retraces to $3.95, letting the yield clear our 4.7% hurdle. Our final forensic classification puts Singtel as a transition hold. Conditional pass for accumulation and transition. Fail for active drawdown. Zone 4 caution. The price drop from $5.02 to $4.59 brought the yield up to 4.03%, an improvement, and the balance sheet remains a fortress. But paying out more than 1 in every 4 cents from asset disposals means you are taking on execution risk in a high interest rate environment where buyer financing is expensive. This slide is the structural layer that every holder needs to sit with. Of every 18.5 cents you received this year, 13.4 cents came from running the actual business. The remaining 5.1 cents, more than 1 in every 4 cents, came from selling assets. That is not a dividend. That is a managed liquidation of the portfolio dressed as income. And here is the part that tightens the risk. that 5.1 cents needs to be funded again next year and the year after through a $3.3 billion transaction pipeline that depends on market conditions, regulatory approvals, and buyer financing. Higher for longer interest rates make every one of those buyers more expensive to close. The execution risk is not theoretical, it is structural. Our watchlist trigger requires two conditions before buying. Either the price drops to $3.95 to clear our yield hurdle, or the financial year 2027 distribution increases purely from core operational earnings growth. Until then, the CPF special account at 4.0% remains the more forensically sound sanctuary for fresh retirement capital, guaranteed return, zero balance sheet risk, no bond refinancing to watch. The question to carry into your next portfolio review is simple. If Singtel's asset recycling program faces a one-year delay and the distribution contracts, does your retirement income plan still hold without touching your principal? In this market, the difference between a sanctuary and a yield trap is decided in a single trading session. Free subscribers are reading yesterday's story. Iggy's elite investors are already cross-checking the next setup together in real time. That gap compounds $9 a month, less than a kaya toast set at Raffles Place. That is the difference between reading the headline and reading the footnotes, between knowing Singtel paid 18.5 cents and knowing that 5.1 of those cents came from selling assets. Iggy's elite investors get the forensic breakdown before the free version drops. Zero-day access, institutional-grade cheat sheets, the full picture before the market has already moved. Link is in the description. 4 boxes. That is the whole audit. The balance sheet is fortress quality, interest coverage ratio 19 times, net debt to EBITDA 1.3 times. That is not where the risk lives. The income structure is where it lives. 27.6% of your distribution funded by asset sales, the value realization dividend growing, and the core yield sitting below our forensic floor. The watchlist trigger is clear. Accumulate at $3.95 or wait for financial year 2027 to show core earnings clearing 4.7% without recycling proceeds. Until one of those conditions is met, zone for caution, transition hold, and the CPF special account at 4.0% remains the more risk-efficient sanctuary at current prices. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds. You said, suggest a good subtitle for this script, entitled 2.